Risk management and trading disciplines usually rank very well on the prioritized list of the most traders. In today's video, I will share 10 tips that will help you to improve your trade and risk management and avoid the most common problems that cause traders to lose money. First, never use fixed stop loss orders. A common risk is to use a fixed amount point pips on your stop loss and to take profit orders across different instruments and even markets. Make move sometimes erratically, sometimes with high volatility without any notice. As a trader, it's part of your duty to factor this into your decisions making process. When declining where to place your stop losses and control, just place your stop losses at the set distance on the very trade and hope for the best. That isn't going to work. It's not a viable strategy. You need to allow space for the normal variables of the market each day. There is something called the average to range (ATR) of the market that will show you the average daily range over any given time period. This can help you to the market's recent and probably current volatility, which is something you need to know when tapping into to figure out where to put your stop losses. Trading with a fixed distance doesn't let you choose reasonable price levels and it also takes away all the flexibility you need to have as a trader. Always be aware of important price levels and barriers such as round numbers, common moving average, Fibonacci levels, or the recent support and resistance. Second, don't close trades without a good reason. Have you ever existence a trade due to the fear of giving back unrealized profits only to see the market continues in the intended directions? I'm sure you have, and if you haven't yet, you will. This is something every trader has to master, the ability of to control emotions in a way that allows you to trade based on pure technical. Always one way to keep your emotions in the check. If you feel the urge to close positions early, is to simply ask yourself, why am I closing these positions? If your answer is anything other than the technical ones, you are likely making a decision based on the emotions. Third, avoid moving your stop to break even too soon. Moving the stop losses of the point of entry to create no risk trade is one of the best risk management strategies you could use. However, one of the most common and experienced mistakes made by the traders is moving to the stop losses to break even too quickly. It is psychologically attractive to move the stop loss to break even in order to enjoy the feeling of removing risk. But it's not a small thing to do, as the trends to result in being kicked out of potentially profitable traders too early. So when the move your stop to break even razor then the moving you stop to ability levels, you should always aim to move it to the strategic levels, one that make that the market has demanded. Important. A very common approach accurately involving waiting for any of the following occur: a failed rated of the entry point, a significant higher heights or lower lows that confirms the entry, a successful breakout in the direction of the trade, a failure breakout against the directions of the trade force. Understands market corrections. Another tricky component to risk management is the ability to control exposed with correlate trades. When it comes to money and risk management, this means that trading instruments which are positively correlated will lead to increased risk. If you are a Forex trader, you can often see a very strong correlations between certain Forex pairs. If you are a stock trader, you will notice the companies within the same industries and sections often move together over a long period. For instance, you spot rising channel of GBP USDT and you decide to set a buy order for the bottom of the channel. At the same time, you also see a bullish divergence GBP GPY, so you also decide to take the trade. When these trades are opened, then you will have two correlated traders that could either double your win potential if the pound keeps replying or double your losses if the pound suddenly sells off. This is why it is essential to avoid opening positions for highly correlated industries. Understanding how the various instruments are related to each other and why some instruments move in the tandem while other diverge allows for the deeper understanding of the market exposed. Fifth, understanding the impact of leverage on the risk management. Leverage is simply a way of trading with more money that you actually have in your account. Now, using leverage can maximize gains, however, it can also increase losses too. If you are leveraged and you make the profit, your returns are magnified very quickly, but at the opposite side, wouldn't will roll your according to this just as quickly too. And too many people have lost their entries trading account by the misuse of leverage. Remember, the greater the amount of leverage on the capital you apply, the higher the risk that you will assume. Selective the right leverage level depends on your experience and the risk tolerance. If you are conservative and don't like taking many risks, or if you are still learning how to trade a lower level of leverage like 5 to 1 or 10 to 1 might be more probable. So familiarize yourself with leverage trading and remain conservative as you learn how to trade and build experience. Keeping your positions small and limiting the amount of the capital for each position is the good start to learning the proper way to manage leverage. It provides a balance where you can come back to and revisit all your past trades to see what you have done wrong and how you developed over time. It will keep you from making mistakes during your trading sessions. 6. Keep a journal and review your trades. Most traders will never look at their trades again after they have closed them. They will just move to the next trade, forget about what they did before, and completely avoid learning ethics. Keeping a trading journal often offers two potential benefits. First, it provides a place where you can come back and revisit all your past traders to see what you have done wrong and how you developed over time. And second, it will keep you from making mistakes during your trading sessions. At the end of each week and months, go back to see what you did, notice common problems, and stop your strengths. These observations can help you to exploit your strengths and highlight the areas you need to work on. The journal objective is to monitor both the performance of your trading strategy and your ability to execute it with consistency. When you reflected your entries after a month of the trading, I assume that you will learn a lot about yourself and about your trading psychology. 7th, give a stop loss room to breeze. Most traders misunderstand what a stop loss really is. At its core, the price levels of your stop loss order is the price where your trade area is no longer valid. Now, placing stop too thin is one of the most common mistakes traders make. Many traders are naturally drawn to the temperament of the place as small of the stop loss on their traders as possible. Admitted. How many times have you been right about a market's directions your trade signals was right, but you still lost money somehow? This keeps happening to you because your stop loss is too thin. The market is fluctuated, unpredictable, and if you place your stop loss too thin, there is a high chance that you will be stopped out before the price continue to go in your directions. It's important to give the price enough room to breathe, and of course, positions seizing play an important role in this equations. 8. Have a trading rules checking a checklist has similar benefits compared to the trading plan, but it serves as the great complementary tool. A checklist must state all your entry criteria and helps each other. And every time you are about to enter a trade, you revisit your checklist and check off the things you can see on your charts. With the checklist, it becomes obvious right away if the trade really match your criteria or not. Again, if you can visualize see what the trade that you are about to take is breaking your rules, and that you should be staying out, you are more likely to avoid those painful mistakes. 9. Have realistic take profit targets. Many traders put way too much emphasis on having higher take profits levels and don't understand that this does not tell you anything about the quality of your strategy. You end up setting unrealistic profit targets for far away from your entry, thinking that by using wide take profit you can increase your reward risk ratio, but it's not as easy as that. Using a wide take profit order means that the price won't be able to reach the take profit orders as easily as if your stop loss strategy isn't on point. You will most likely to see the decline in your win rate. You need to be able to determine suitable profit targets, one that gives you a realistic profit target but also gives you a sensible risk to reward. There are many ways in which you can set your profit target using technical indicators and other tools, but two of the most efficient ones are support resistance levels and daily range levels using ATR indicator. 10th, understand your fears in trading. Every trader, no matter how experienced or inexpensive, faced the same fears. In order to manage your trades and become consistent, you need to understand your fears. Maybe you get anxious when you are in a profit and feel the urge to the close trade. It means you have the fear of the profits becoming losses, or instead of the losing to your analysis, you fail to pull the target because you fear that you have missed or overlooked something. That's the fear of mistakes, or maybe you just have fear of being wrong. That's when you experience a few success in the targeting and you start to develop an ego. Then instead of the making things trade that can make you the most money, you make the trade that best protect your ego. Or you suffer from the FOMO, the fear of missing out, when impatience and greed take over and you enter the trade just because you feel the market is moving without on board. You must know yourself and understand the fears that appears inside your mind when you are trading, because this is the first steps toward to conquering these fears and becoming a better trader. As always, if you learned something new and found value, leave us a like to show your support, subscribe to channels and check the bell icon to stay in touch when we release new video. Until next time.